Welcome to Law Easy. My name is Marty Shenkman, and I'm joined today for this video clip with insurance consultant Richard Harris. And we're going to talk about how to build a life insurance policy. It's a little like Build-A-Bear, but more fun. So maybe I should get my grandkids, instead of Build-A-Bear, build an insurance policy. How do we do it?
I don't think they'll be happy.
No?
No. I tried it with my grandkids, and they weren't thrilled.
Tell me about building building an insurance policy. What is the concept? Don't you just buy a policy that the agent gives you? What is it we're building?
Well, what you're building is built around what you're trying to accomplish. So the first thing is, what are you trying to accomplish? Do you want insurance for a particular period of time? Do you want insurance until the day you die? And you start out with that. In terms of that, do you want to build cash as a hedge, or are you not concerned about building cash as
cash value in the policy?
The cash value in the policy. So those are the things that you start out with the client with. And the idea is, in my practice, the idea is to take the client along a path where they're making informed decisions each step of the way as they're building the policy. Because in the end, what happens is they turn to me and say, Richard, why shouldn't I do this? And that's the reason they're asking that, is because
they've gotten to the right point.
They have built it. They have signed on and built it themselves, and that I believe is the way.
You also mean conceptually in the client's mind of what they need and why they need it and how it fills that goal.
Exactly.
And what about in terms of flexibility, given that the future is so unknown? I mean, sitting here today, we have an 11.18 million exemption. Next year, 11.4. In 2026, it's half that. We could have a blue wave continue and have who knows what happened to the estate tax, if that's one of the factors. How do you begin to address that in the context of building a policy?
Well, you build it, let's say somebody wants a policy today, and let's say they're more of a bubble person. Let's say they have...
You're going to explain bubble.
Yeah. Let's say they have a $30 million estate, and right now they have a $22 million plus exemption. However, that can go back to $11 million. Half of that. And if they're concerned and they want the policy to pay estate taxes, well, initially, if that's your goal and your estate is $30 million, rough envelope calculation, you've got $8 million. At 40%, you're going to need roughly $3,200,000 of insurance. However, if that $11 million goes away, that's another 40%, and that's another $4.4 million. So what you may want to do, you may take either of two tacks. One, take out a policy for the larger amount, and then see what happens, and see whether your estate is growing also, because your estate growth, even if the exemption stays the same, may create the need for the additional insurance. The other way is maybe...
So are you suggesting then buy a larger amount of insurance and then cancel a piece later?
Cancel a piece later, or buy insurance where there's a big term component to it, so that you can drop it. Exactly.
So those are some of the ways to build in the flexibility given the unknowns.
Exactly.
Which makes a lot more sense than the ostrich approach of doing nothing, which so many people are taking. In terms of building a policy, what are some of the other factors or circumstances you see people give thought to?
Well, one of the things is, how much of a guarantee do they want in their policy? For example, I want a policy that's going to be guaranteed that if I pay the premium, no matter what happens, they're going to pay the death benefit no matter when I die. Now, there are two types of policies that can do that. One would be whole life, and the other is a policy called Secondary Guaranteed Universal Life, or GUL. And GUL is a policy, when I describe it to clients, I talk about being term forever, because whatever cash value you might have had is going to go away. But you can get a guarantee. If you're going to go with a GUL policy, I recommend funding it quickly, because It's sensitive to when you make premium payments, and if you don't make premium payments later on, the guarantees that you thought you had, you won't have. Whereas whole life, the guarantee is there as long as you make the premium payment.
But for whole life, you need to monitor whatever you're doing once you build it.
Even with whole life, you need to monitor what you're doing. There isn't any insurance policy that doesn't need to be monitored. First thing, client circumstances change. Why, the reason they bought the insurance then may no longer be the reason they want to have the insurance now.
What about performance? Isn't whole life pretty fixed in stone?
No.
We had another video clip with Bill Boersma where we were talking a little bit, but I think it's worth emphasizing because I think it's very much misunderstood how the cost of the policy, the returns on the policy could still affect performance even on a whole life.
There are two components to a whole life policy. One is the policy itself, and the other is the dividends that you're getting for being a policyholder with a mutual insurance company. The policy itself, there's guaranteed cash value, guaranteed death benefit. That won't vary. The dividends will, because they're based on all of the things, the cost of insurance, interest rates.
And how does the variation of the dividend affect the policy and what I'm holding it for?
Well, in one sense, you may be looking at it to pay a certain number of premiums and then have the policy be what we call self-fund. Self-fund doesn't mean the premium disappears. It just means that at that point in time, based on the projection at that time, it's projected that you won't have to make any more premiums, that the dividends will cover the premiums.
So if the dividend's adversely affected, that assumption could be pretty bad, which is another reason why people have to review this, because if they're in a self-funding mode, they better evaluate and make sure it's still in self-funding mode.
Exactly. The fact that it was in self-funding mode isn't a forever situation.
Right. Good point. Anything else that you want to talk about in terms of last-minute wrap-up points on what to think about when designing or building an insurance policy?
I mentioned conservative. There are various ways. If you're going to build a permanent policy and there's going to be cash value, there are various ways that cash value can be invested. One is just give it to the insurance company and they invest it in what's called a general account. And that's primarily high-grade bonds, and that's the return that you're going to get. However, depending on your risk tolerance, you may want to take an approach where you buy a policy where some of the return hinges on the performance of a stock index. If you really want to take a risk and you really understand and you're willing to have the policy managed by an asset manager, then you may want a variable policy where the underlying, what are called sub-accounts, are investments in stocks and bonds. So depending on your risk tolerance, those are things you'd look at.
All right. Thank you, Richard. Thank you for joining us. Please keep in mind that these videos are for educational, I almost said entertainment, but educational purposes only. Be certain to talk to advisors before taking any action. Thank you.